And the closing bell rang about 15 minutes ago, and the scoreboard is just brutal.
Yeah.
S&P 500 closed down 0.90% to 7,320.41. The Nasdaq plummeted 1.40% to 25,320.8.
Yeah, and the Dow, I mean, shedding over 900 points intraday to break right back below that 50,000 threshold, it was heavy.
Really heavy. So for today's deep dive, we're pulling from a stack of post-market strategy notes from the Bulls, Bears, and the Bell series. Our mission today is to figure out, why the market moved like this. Was it a complete panic or maybe a highly organized strategic exit?
Right, because on the surface, it looks like a total bloodbath, like someone just yelled fire in a crowded theater. But if you dig into the narrative, we're dealing with a really toxic macro cocktail here.
Yeah, we have a major geopolitical shock colliding head-on with some nasty economic pressure.
Exactly. I mean, overnight, we saw the U.S. and Iran trading military strikes near the Strait of Hormuz. And when something like that happens, algorithms just instantly price in a worst-case scenario for global supply chains.
And look, we always impartially report the geopolitical drivers here without taking sides, but you have figures like Donald Trump warning that Iran will, quote, pay the price. The market hears that, and the risk premium is just immediate.
Oh, instantly. Algorithms don't care about the politics, they care about logistics. That's why Brent crude oil spiked right up to $93.89.
Right. And WTI crude neared $89.60. So you have this massive commodity spike on the exact same day that the headline May CPI printed at a 3-year high.
Yeah, 4.2% year over year. It's an absolute nightmare scenario for the Fed. They can't cut rates because of inflation, but the oil spike is essentially a tax on the consumer.
Is stagflation anxiety. But here's where I want to push back on the panic narrative. When I look at the S&P 500 volume today, it was 1.29 billion shares.
Right.
Which is, it's actually slightly below the 30-day average. If the sky is genuinely falling, wouldn't we see volume just explode through the roof?
You would. If this was a true retail washout, mom and pop just liquidating everything, you'd see 2 or 3 billion shares. The fact that volume was average tells us the institutions were doing a really methodical defensive draining of liquidity.
They aren't dumping, they're distributing.
Yeah.
And they actually use the morning data to do it right, because we had that morning fake out.
Yeah, the head fake was brutal. So core CPI, which strips out food and energy, printed a tiny bit cooler than expected at 0.2% month over month.
And that gave everyone this fleeting glimmer of hope. The S&P actually poked into positive territory, hitting 7,396.56.
It did, but it was a massive trap. Institutions aggressively faded that rally. Instead of, buying the dip, the sellers stepped in and overwhelmed the retail money, driving everything straight down to close at the dead lows.
A textbook key reversal into the close.
Yeah.
And a huge chunk of that selling was focused on tech, specifically the AI exhaustion.
Oh, the AI momentum trade is officially exhausted. And the trigger was supermicrocomputer, SMCI.
Yeah, so SMCI announced this massive $7 billion equity and convertible preferred financing package just to fund their AI server backlog. And to me, it's like AI companies were the VIP room of a club, right?
Uh-huh.
But suddenly they're asking everyone inside to pay this massive new cover charge. You've got SMCI's $7 billion raise, Alphabet's $85 billion raise.
And investors are looking at the math and realizing the VIP room is getting way too expensive. SMCI's gross margins are sitting at just 6.3%. They're taking on massive dilution for razor-thin profits.
That sparked a total AI valuation purge today. SMCI plummeted 15.75% down to $34.24 on massive volume.
It was a bloodletting,
Yeah.
and it dragged the whole semiconductor trade down with it. Tech is officially the laggard. Look at Micron, ticker MU.
Right, MU had a brutal outside reversal.
Exactly, ending down 3.1%. When a leader like that prints an outside reversal, it means the momentum trade has just lost its immunity. The grace period is over.
Okay, so tech is burning. The Nasdaq is down 1.4%. The index is bleeding. If you're a retail trader looking at your phone, you probably think your entire portfolio is getting crushed.
But the internals tell a completely different story.
They really do. This was the most shocking data point in the briefs for me. Despite the S&P dropping nearly a full percent, 62.7% of all U.S. issues actually advanced today.
Yeah, it's wild. Even inside the S&P 500, you had 230 stocks advancing versus 271 decliners.
So it's basically an even split under the surface.
Which is the exact definition of inverse divergence. For a year, the cap-weighted index rallied solely because of mega-cap tech while everything else flatlined.
Yeah.
Today was the exact opposite. The index is basically lying to you right now.
So if you're listening to this and the NASDAQ is on fire, where's all this institutional money actually going? The real money has to be buying something.
It is. Capital is migrating, not vanishing. They're rotating heavily out of high multiple AI tech and finding a home in fundamental value, financials, defense, and particularly energy.
Right? Energy catches that heavy defensive bid because of the Middle East escalation.
Exactly. It's healthy digestion, honestly. It's not a systemic collapse.
Let's make that rotation concrete because
Yeah.
the winners and losers today really map this out. The fundamental winner that jumped out was Casey's General Stores, ticker CSY.
Oh, what a chart.
Right. While tech was imploding, this convenience store chain staged this explosive breakout, surged 15.68% to close at $880.53.
Because they delivered a blowout Q4 earnings report with 30.9% EPS growth. Tangible earnings growth is commanding a massive premium over future AI promises right now.
But then you look at our industrial loser, Caterpillar, ticker CAT. It's the total opposite.
Yeah, CNT is the poster child for cyclical industrials buckling under inflation. I mean, it cratered 5.28% today, down to $866.42.
Which single-handedly shaved about 300 points off the Dow. But speaking of things buckling, we have to talk about the failed safe haven today.
Gold.
Yeah, gold. Usually military strikes in the Middle East mean you just blindly buy gold. But August gold futures plunged $141.40 today to close at $4,145.
Yeah, Citi put out a really stark warning on that. They see a 20% downside risk for gold if the Strait of Hormuz remains closed through the summer.
Wait, really? So gold is getting dumped, tech is getting purged, and everyone is piling to oil and a pizza convenience store chain. I mean, it sounds like Wall Street is entirely rethinking what value actually means.
Well, they have to. Look at the volatility. The VIX surged 10.2% today, up to 21.90. That is well above its historical average.
So cheap protection is just officially gone.
Exactly. When the VIX spikes like that, options become prohibitively expensive. Real cash flows are the only safe haven left.
Which brings us to the look ahead for tomorrow, because we are sitting on a technical powder keg right now. The briefs were incredibly focused on this gamma wall for the S&P 500.
Yeah, the zone between 7,230 and 7,240. It is the critical line in the sand.
Right, because that lines up perfectly with the 50-day simple moving average. Walk us through the mechanics of that, because if we close below 7,230, things get dangerous, right?
Extremely. Because right now, options dealers are holding the market up. But if the S&P closes below 7,230, those dealers transition into what's called negative gamma.
Meaning they're forced to sell.
Exactly. They have to sell index futures to hedge their books. It creates a negative feedback loop, a total vacuum that opens a trapdoor straight down to the 7,000 level.
So for you listening, 7,230 on the S&P is the alarm bell for tomorrow.
Oh.
If we breach that, it's a completely different ballgame. And we have some massive catalysts hitting the tape that could tip the scales.
Right. Thursday morning, we get the May Producer Price Index, the PPI. If wholesale inflation is as hot as CPI was today, that gamma wall is going to be tested heavily.
But tech might try to save the day. Oracle just put out their post-market Q4 numbers, and it was a blockbuster cloud revenue beat. I mean, revenue surged 21% to $19.2 billion.
It's a huge print. The question is, can Oracle single-handedly save the AI narrative tomorrow morning?
Especially with another huge liquidity drain happening Thursday night. SpaceX is pricing their $75 billion IPO. So between SMCI, Alphabet, and SpaceX, the market is just drowning in new paper.
Right, which is why the institutional trading desks are looking at some very specific day two plays. They're currently pricing in a 65% probability of trend continuation to the downside.
So they're favoring asymmetric setups.
Exactly. The notes show guys going long on the VIX and long on front-month WTI crude, playing that Middle East escalation.
And what about short setups?
They are looking for short continuation on SMCI if it breaks below $34, and also watching CET. If Caterpillar shows weakness below 864, it's going to get treated like an ATM by sellers.
So just to summarize all of this, I mean, we watched the market get squeezed by geopolitical strikes and a hot 4.2% inflation print today, which triggered this methodical rotation out of AI tech and into energy and value, setting us up for a huge showdown at that 7,230 gamma wall.
Yeah, that's the mechanical reality. But I want to leave you with a broader thought here, something that wasn't explicitly in the notes, but it's the natural conclusion of all this.
What's that?
If we get a 4.2% inflation print plus a major war escalation, and the result is actually positive market breadth for the average U.S. stock, Are we finally seeing the end of the mega cap tech
Look,
monopoly?
wow, I mean, for a year, it's been the S&P 5, not 500.
Right. If the index giants aren't the whole market anymore, does a tech crash actually mean a healthier, more normalized economy for everyone else?
That is a fascinating question to chew on.
Yeah.
So keep an eye on 7,230 tomorrow. Watch those day two plays and stay curious. We'll see you on the next deep dive.